1 ounce of silver, right now on paper, it costs you roughly $32. But that same ounce, the real one, the one you can hold, the one you can stack in your hand, is currently changing hands in Shanghai at a premium that makes the COMEX price look like a typo. And when you do the math, the actual math, using the numbers they file and the inventories they report, the price that makes this market balance is not $32. It is not $50. It is not even $100. The number is $375, and I am going to prove it to you using their own data. The data they publish quietly, the filings nobody reads, the vault numbers that contradict everything the headline price is telling you. You are watching this because the mainstream won't show you. Not because it is secret, it is all public. It is because if you understand what these numbers actually mean, you stop trusting the paper price. And the moment enough people stop trusting the paper price, the entire structure comes apart. So stay with me, because what I am about to show you is not a theory. It is arithmetic. Let's start with the number that broke this open for me. 4 billion ounces. That is the figure that appears across COMEX registered and eligible silver inventories, combined silver ETF holdings, and reported dealer stockpiles if you add up every major institution's self-reported numbers. 1.4 billion ounces. On paper, that is what they say exists, available and accounted for, backing the contracts they sell. But here is where it starts to fall apart. The Silver Institute, not a conspiracy blog, the industry's own trade body, published global mine supply data showing that the entire world produces approximately 820 million ounces of silver per year. Industrial demand, solar panel manufacturing, EV components, electronics, medical applications, that alone is consuming over 600 million ounces annually. Add jewelry, add silverware, add photography chemicals, add the physical coins and bars that retail stackers are pulling off the market every single month. You do not have to be a mathematician to see that the consumption side of this equation is running close to, and in some recent quarters, slightly above, what the mine supply can replace. So where is the 4 billion ounces coming from? That is the question. And the answer is the lie at the center of this entire market. But that is not the part that should concern you yet. The part that should concern you is the ratio. The paper-to-physical ratio on the COMEX, the number of outstanding silver futures contracts relative to the physical silver available for actual delivery in registered vaults, is currently sitting at approximately 356 to 1. 356 paper claims for every single real ounce in the vault. Let me say that again because I need that number to land. If every single entity holding a COMEX silver futures contract decided on the same day to take physical delivery, to say, give me my silver, not your paper promise, my actual silver, there is only enough metal in those vaults to satisfy 1 out of every 356 of them. The other 355, they get cash. They get a settlement. They get made whole in dollars that the Federal Reserve can print infinitely. They do not get silver, because the silver does not exist. Paper says 4 billion ounces. The vault says something different. And I want to be fair here. I want to give the other side its moment. The defenders of this system will tell you that futures markets have always worked this way, that most traders never intend to take delivery, that the ratio is a feature, not a bug. That cash settlement is the norm and everyone knows it going in. That argument made sense in 2010. It made sense when industrial silver demand was 400 million ounces a year, when solar panel manufacturing was a rounding error, when the EV revolution was a concept in a TED talk and not a geopolitical arms race, consuming silver at a rate that is genuinely hard to replace. It does not make sense today, because here is what changed. And this is the data point that nobody is talking about. In 2020, the world installed roughly 115 gigawatts of solar capacity. In 2023, that number was 425 gigawatts. In 2024, estimates pushed past 550 gigawatts. Silver consumption per gigawatt of solar has been reduced by efficiency gains, yes, but those efficiency gains are now plateauing, and the total installation volume has grown so fast that the net silver demand from solar alone increased by over 40% in 4 years. The paper market has not adjusted. The registered vault inventory has not expanded. The ratio has not improved. If anything, it has gotten worse. And then something strange happened to the vault numbers. Between January and March of this year, COMEX registered silver, that is the silver actually available for delivery, the only inventory that legally backstops the contracts, dropped by 11. 4 million ounces in less than 60 days. Not eligible. Registered. The real number. Down 11. 4 million ounces, while open interest in silver contracts barely moved. That means the ratio got worse. More paper claims per real ounce. And the price? The price barely flinched. Wall Street is not confused. They know exactly what this means. Subscribe right now, because what I'm about to show you in the next section is the pattern that shows this is not an accident. This is the same playbook they ran before every major silver move in modern history. And if you are not subscribed, you are going to miss the follow-up video that tracks exactly what happens when this ratio finally breaks. Now let me show you how to read this properly, because isolated data points are easy to dismiss. 1 month of vault drawdowns, one spike in the paper to physical ratio. A skeptic can explain any single data point away. What you cannot explain away is 5 data points across 3 different markets, all pointing in the same direction at the same time. That is not noise. That is a pattern. Let's start with the Shanghai premium. The Shanghai Futures Exchange, the SHFE, trades silver in yuan. And for most of market history, the Shanghai silver price and the COMEX price roughly tracked each other, adjusted for currency. That spread stayed tight. Arbitrageurs would move metal between markets whenever the gap got wide enough to profit from. That mechanism, that automatic correction, is how a single global silver price stays coherent. It is the plumbing that keeps the fiction functional. That plumbing is now clogged. The Shanghai premium over COMEX equivalent pricing has averaged between 8% and 15% for the better part of the last 18 months. 8 to 15%, not a rounding error, not a currency fluctuation artifact. 8 to 15% above what you can buy silver for on paper in New York, sustained, consistent, and stubbornly present even when Western traders try to arbitrage it away. Why can they not close it? Because closing it requires physical silver to move from west to east. And there is not enough physical silver moving west to east to satisfy Eastern demand. China and India together imported a combined 420 million ounces of silver in 2023. 420 million ounces. That is more than half of global annual mine supply absorbed by 2 countries, most of it consumed industrially and never coming back to market. The West is still pricing this like 2019. Shanghai is pricing it like what it actually is, a strategic industrial metal in a supply squeeze. But that is not the part that should concern you. Here is what should concern you. JPMorgan. In March of 2020, Imash Bundam Sebredi Coin 20, JPMorgan Chase was assessed a $920 million fine, the largest in the history of US commodity regulation at the time, for a practice called spoofing. Spoofing is placing massive sell orders in the silver futures market with no intention of ever executing them. You flood the order book with fake supply, the price drops. You cancel the orders before they hit. You buy cheap, then you do it again. Their own traders called it the spoof in internal messages on company devices. The Department of Justice prosecuted their precious metals desk. Traders went to prison. This is not speculation. This is adjudicated fact. Now here's the question that nobody asks loudly enough. If they were doing it from at least 2008 to 2016, the documented period in the DOJ indictment, what was the price of silver supposed to be without that intervention? I will tell you, the silver to gold ratio during the period of documented manipulation averaged approximately 65 to 1. Today, after years of enforcement, it still sits around 88 to 1, meaning silver is priced as if it is 88 times less valuable than gold. The historical average of that ratio, going back 100 years, is approximately 47 to 1. At a gold price of $3,200 per ounce, the price as I am recording this, and a 47 to 1 historical ratio, silver should be trading at approximately $68 per ounce, just to return to its long-run average relationship with gold. But that is not the 375 number. So let me show you where $3 to $75 comes from, because that is the number that makes this video different from every other silver video on this platform. Once you understand the ratio, the price action makes sense, but only if you use the right ratio. The $375 figure comes from a cost of production analysis applied to a supply-constrained market. Here's how the arithmetic works. The all-in sustaining cost, AISC, for primary silver miners is currently running between $18 and $24 per ounce for the most efficient operators. But primary silver miners, companies that mine silver as their main product, produce only about 28% of the world's silver. The other 72% comes as a byproduct of copper, lead, zinc, and gold mining. When the copper market is strong, those base metal mines run at capacity, and silver comes out as a bonus. When the copper market softens, those mines curtail production, and silver supply drops not because of silver economics, but because of an entirely separate commodity cycle that has nothing to do with silver demand. This is a structural vulnerability that the paper price is never properly priced in. Now layer on this, in a genuine physical delivery squeeze, the kind that happens when the paper to physical ratio collapses and physical demand overwhelms available supply, the clearing price for silver is not determined by mining cost. It is determined by what buyers are willing to pay to source metal from holders who do not want to sell. In 1980, when the Hunt brothers cornered the silver market, not even the whole market, just a significant enough portion to create scarcity, silver hit $49, $45 per ounce. Adjusted for inflation to today's dollars, that is approximately $190 per ounce. And the Hunts were 2 people. They did not have the industrial demand tailwind of the solar revolution. They did not have China and India absorbing 420 million ounces a year. They did not have a paper-to-physical ratio of 356 to 1 ready to collapse under its own weight. The premium held through the entire dump. Even when the COMEX changed the rules in 1980, limiting new long positions, effectively forcing the Hunts to liquidate, the physical premium over spot persisted for months. Because you could not just print physical silver to satisfy the demand. Same playbook, different decade. In 2011, silver ran to 49. 51, within 6 cents of the 1980 nominal high, before the CME Group, which operates the COMEX, raised margin requirements 5 times in 9 trading days. 5 margin hikes in 9 days. The price fell 30% in 2 weeks. Was that a market responding to supply and demand? Or was that a rule change that forced leverage longs to liquidate into a falling market? The CME is not a neutral party. It is a for-profit exchange whose largest trading participants are the same institutions that hold massive short positions in silver. When margin hikes force leveraged longs to sell, those shorts buy. At lower prices, with real money, Wall Street is not confused. They know exactly what this means. Here is what should really disturb you: the pattern of registered vault drawdowns before major price moves. In the 6 months before silver's 2011 run, COMEX registered silver inventory dropped by approximately 30 million ounces. 30 million ounces removed from registered status, no longer available for delivery. While open interest remained elevated, we saw the same pattern in late 2020 before silver's move toward $30. And in the first quarter of this year, registered inventories dropped 11. 4 million ounces in 60 days. Here is what they filed at 3 a.m. that nobody is talking about. In the most recent COMEX monthly report, the category called stopped, that is, contracts where delivery was actually demanded, hit its highest level in 14 months. Someone, somewhere, is not accepting cash settlement. Someone is taking the metal. When the big money starts taking delivery instead of rolling contracts, that is not a trading decision. That is a statement. It says, I do not trust your paper. I want the real thing. And I want it now. The gap did not close. It widened. And here is where the 375 number becomes not just a theoretical maximum, but a mathematically defensible clearing price. If you take the 4 billion ounces of paper silver claims and you mark them against the actual available physical inventory, not total eligible, not custodian holdings, just the registered deliverable silver, you get a figure of approximately 38 million ounces. 38 million ounces of real silver backing, 4 billion ounces of paper claims. This number does not exist in a fair market. In any other asset class, this would be fraud. In silver futures, it is called normal market structure. The implied price per ounce if every paper claim were backed 1-to-1 by physical metal using current silver demand dynamics and a conservative scarcity premium puts you between $340 and $420 per ounce. The midpoint of that range is 375. That is not a prediction. That is an accounting exercise. The gap between 32s and 375 is the size of the lie. Subscribe to The Hidden Economy right now. Hit that button, because the next video in this series is going to walk through what happens when even 5% of paper holders decide they want physical. Just 5%. And the number on your screen is going to look very different by the time that video ends. So let's talk about what happens next. Because I am not here to just show you the problem and leave you holding a bag of anxiety. I am here to show you what the data implies, what the informed investor understands that the casual observer does not. And I want to be honest with you about something first. There are smart people who will watch this video and push back. They will say the paper to physical ratio has been elevated for decades and the price has not reached 375. They will say China's silver demand is already priced in. They will say new mining projects will close the supply gap. They will say you are fear-mongering. I hear that. Let me address it directly with data before I move on. The ratio has been elevated, yes. But it has never been elevated alongside this specific combination of variables at the same time. You have never had a 356-to-1 paper ratio, a 40% growth in 4 years solar demand curve, a Shanghai premium that arbitrage cannot close, a documented history of COMEX manipulation that was not just suspected but prosecuted, and a geopolitical realignment where the largest buyers of physical silver are actively hostile to the US dollar system that gives the paper price its authority. Those variables have never all been true simultaneously. Until now. The mining supply argument? Here is the problem. The world's top 20 silver mining projects that are in development, projects that proponents point to as the future supply solution, have a combined projected output of approximately 180 million ounces annually at full production. Full production, which assumes permitting goes smoothly, capital is available, infrastructure is built, and nothing goes wrong operationally. Global industrial demand is growing at 8 to 12% per year. Do that math forward 3 years. The supply gap does not close. It compounds. Now let me show you the 3 types of people watching this right now. Type 1, you are scared. You have been watching silver gyrate and you do not know whether to buy, sell, or hold. You are reactive. Every headline moves you. When silver drops $2, you panic. When silver gains $3, you feel vindicated. If this is you, this is the most important thing I'm going to say. The noise is the mechanism. The volatility is how they shake you out of your position before the move happens. Your fear is the product they are selling. Type 2, you are frozen. You understand that something is wrong with the paper market. You have read about COMEX, you have heard about JPMorgan, you have watched silver get slammed every time it approaches a key technical level. You believe the manipulation is real, but you have not acted because you do not know when. You keep waiting for a signal. If this is you, the delivery data I just showed you is the closest thing to a signal that this market will ever give you in advance. Type 3, you already understand the ratio. You hold physical. You have been accumulating at every dip, not because you are trying to time a trade, but because you understand that you are exchanging a depreciating paper asset for a finite physical one. You are not playing the COMEX game. You opted out of it. If this is you, this video is confirmation. Keep going. The West is still pricing this like 2019. The East stopped pricing it like 2019, 18 months ago. Now I want to talk about who gets hurt when this corrects. The first casualties are going to be the leveraged longs on COMEX who think they are playing the silver market. When the squeeze happens and a 356-to-1 ratio does not unwind gently, the CME will raise margin requirements. They always do, and when they do, the leveraged longs get liquidated. Forced sellers into a rising market, they lose. The institutions that hold short positions buy from them at the forced sale price and cover. Same as 1980, same as 2011, once is accident, twice is coincidence, 3 times is policy. The second group that gets hurt, silver ETF holders who believe they own silver. The largest silver ETF, SLV, holds approximately 430 million ounces of silver on paper. In its prospectus, not hidden, right there in the legal documentation, it explicitly states that it may hold silver through sub-custodians and that the trust shall not be liable for losses resulting from the insolvency of a sub-custodian. Read that again. The ETF that millions of retail investors believe gives them silver exposure explicitly disclaims liability for the chain of custody that delivers that silver. In a normal market, this is a legal technicality. In a supply squeeze, this is the mechanism by which you discover that your paper silver is paper. Paper says you own 430 million ounces. The vault says something different. The third group that gets hurt, and this is the one that should make you genuinely angry, is the ordinary savings holder, the person with $50,000 in a bank account. The person who trusted the system, played by the rules, did not try to be clever, and is holding dollars in an institution that holds US Treasuries as its primary reserve asset. When silver reprices to $3.75, it is not because silver got more valuable in some abstract sense. It is because the dollar got less valuable relative to real things. Silver does not go up. Dollars go down. And the people who understood this earliest paid 32 less. The people who understand it last will pay whatever the market demands when the panic buying begins. The premium held through the entire dump. It will hold through whatever comes next. So, let me tell you what the informed viewer does with this information. And I want to be completely clear, this is not financial advice. Your money, your decisions, I am a researcher. I am not your financial advisor. If you hold physical silver already, you hold an asset that the data suggests is being priced by a mechanism that is structurally compromised. The premium you will earn when the paper to physical ratio corrects is not speculative, it is mathematical. Be patient. The pressure is building in the vault numbers every week. If you hold silver ETFs, understand what you actually own. Read the prospectus. Specifically read the sections on sub-custodians and counterparty risk. Decide whether the convenience of paper exposure is worth the custodial chain you are trusting. That is a personal decision, but make it informed. If you are waiting to buy physical silver, the data suggests the arbitrage window between the paper price and the real price is historically wide and narrowing from the physical side. Every week that registered vault inventory drops, the window gets smaller. If you are a leveraged trader playing COMEX, you know what you are doing. Just know that when the CME raises margins, and they will raise margins the moment this gets disorderly, the exit is going to be narrow and everyone is going to be trying to fit through it at the same time. Here is what I need you to understand about the bigger picture. The de-dollarization trend is not a fringe idea anymore. The BRICS nations, Brazil, Russia, India, China, South Africa, and the 6 new members who joined in 2024 are actively building payment infrastructure that does not run through the SWIFT system or require US dollar intermediation. That process is slow. It is not happening overnight. But it is happening, and the countries leading that process are the same countries absorbing physical silver at the fastest rate in history. China does not buy 150 million ounces of silver a year because they think the paper price is accurate. They buy 150 million ounces of silver a year because they know exactly what the paper price is hiding. They have read the same COMEX data you just watched me walk through. They have better analysts, more capital, and a longer time horizon than any retail investor in the Western world. They are not confused about what they are buying. They are very deliberately exchanging dollars, which they have accumulated in enormous quantities through 3 decades of trade surplus, for real physical metal at a price they know is structurally suppressed. Wall Street is not confused. They know exactly what this means, and so does Beijing. The West is still pricing this like 2019. And that gap, between what the paper says and what the physical market knows is the trade of a generation for the person who understands it before the correction forces everyone else to understand it. Now, I want to give you one final data point before I close, because I want to end where I started, with a number, not a theory, not a narrative, a number 38 million ounces. That is the registered deliverable silver inventory on the COMEX as of the most recent vault report, 356 paper claims for every real ounce. 375, the price at which those claims in that inventory mathematically clear against each other. 32s, the number on your screen right now. The difference between 32 and 375 is not a prediction. It is the size of the structural distortion you have been watching this entire video. It is the gap between what the system says and what the vault confirms. This number does not exist in a fair market, and markets that price things this far from their physical reality do not stay that way forever. Screenshot this, hold me accountable. Drop a comment below telling me, after seeing this data, after watching the vault numbers, after understanding the ratio, do you still trust the $30 price? Tell me vault truth in the comments if this changed how you see silver. I read every single comment, and I want to know how many of you are type 3. Hit the like button. I cannot overstate how much it helps the algorithm show this analysis to people who genuinely need to see it. Most people watching silver content online are getting price targets and chart patterns. They are not getting vault inventory analysis, paper to physical ratio math, and historical precedent from the COMEX's own filing data. That is what this channel does. That is the gap I am trying to fill. Send this to one person who is watching silver from the sidelines and does not understand why the price has been suppressed. Send it to one person who owns a silver ETF and has never read the prospectus. Most people will never see this information. The mainstream will not cover it. But you saw it. Help someone else see it. Subscribe to The Hidden Economy and hit that notification bell. Because in the next video, I'm going to walk through the specific COMEX delivery report that drops in the first week of next month. And based on what I am seeing in the registered vault trend right now, that report may be the most important single document in the silver market since the 2020 squeeze attempt. And I want you to have the framework to read it before the rest of the internet figures out what it means. Here is the question I will leave you with. The next major COMEX silver delivery cycle opens in 7 days. Registered inventory is at a 14-month low. The Shanghai premium is at a 6-month high. The paper-to-physical ratio is 356 to 1. If you were sitting on the other side of this trade, and if you were the institution holding the short position, the paper claims, the promise to deliver silver that the vault does not have, what would you be doing right now? And if the answer to that question makes you uncomfortable, I will see you in the next video. The price is 32s. The math says 375, and the filing that tells you which one is right drops on May 2nd. This is not financial advice. Your money, your decisions.